Hi friends, in this video we're going to discuss about final accounts. Friends, what do you mean by final accounts? Final accounts mainly comprises of trading and profit and loss account and balance sheet. Friends, we might have already discussed the financial statements. The financial statements mainly consist of trading and profit and loss account, balance sheet, cash flow statement, notes to accounts, etc. Here, see a foundation point of view. Friends, we mainly focus on trading and profit and loss account as well as balance sheet. Final accounts are prepared to show periodic performance and financial position of any organization. Every business enterprise and all the stakeholders wants to find out how the business is doing. To find out the wealth and health of the business concern for the specified period of time as well as on the specified date, final accounts are prepared. These final accounts give a crystal picture with regard to financial performance of the business concern as well as financial position of the business concern, with which various important financial decisions can be taken by all the relevant interested stakeholders of the business in the business. Friends, now let us first discuss about trading account. This account is prepared to ascertain the trading results of the business. Friends, what is trading? Trading is nothing but purchase of goods for the purpose of selling for a consideration. Towards purchase of those goods, various expenses may incur. And trading account reflects the opening stock, if any, the purchase of material, and expenses incurred towards that purchase of material, as well as closing stock of material, with which the cost of goods sold can be ascertained. And such cost of goods sold is deducted from sales. If sale proceeds are greater than COGS, there amounts to gross profit. If sales proceeds are lesser than COGS, it does amount to gross loss. Meaning thereby, friends, the very purpose of preparation of trading account is to ascertain gross profit or gross loss for the specified period of time. Here friends, what is COGS? As I mentioned earlier, COGS is equal to opening stock of material plus purchase of material plus all direct expenses related in connection to the purchase of that material minus closing stock of that material minus purchase returns, if any. I repeat friends, sales minus COGS is equal to gross profit. COGS minus sales is equal to gross loss. I reiterate friends, if sales is greater than COGS, it does amount to gross profit. If sales is lesser than COGS, it does amount to gross loss. Such gross profit or gross loss will be transferred to profit and loss account. Friends, now let us see the items that which will appear in trading account, which are very important to prepare trading account. Here friends, proprietary business concerns need not follow the format that which is followed by the companies as per Company Act 2013. And hence, trading account can be prepared in a tabular form, that is in very T shape. So if I divide the table in two parts, left side as well as right side, left hand side, that is debit side, right hand side, that is credit side. The items that will appear to the debit of trading account are to opening stock, if any, to purchases as reduced by purchase returns, as reduced by drawing of goods by the proprietor, to freight on purchases, carriage on purchases, wages, any other direct expenditure which is in relation to the purchase of material is to be debited to trading account. The right hand side, that is credit side, mainly we show sales, closing stock. Friends, we have already discussed about the balancing of an account. Even trading account is to be balanced. If credit side of the trading account is greater than the debit side, it is called as gross profit. If debit side of the trading account is greater than credit total of the trading account, it is called as gross loss. Such gross profit or gross loss are transferred to profit and loss account. If there is any gross profit, it is credited to profit and loss account. If any gross loss, it is debited to profit and loss account. Friends, the entry for closing stock. There are two treatments. The accounting entry for closing stock. Number one, closing stock account data to trading account. Alternatively, even we can pass another entry, that is closing stock account data to purchases account. I repeat friends, there are two treatments. Number one treatment for closing stock account data to trading account. Number two, closing stock account data to purchases account. Friends, one more important treatment to be considered in the preparation of trading account is sales GST. Sales GST is collected by the seller from the buyer at the time of sale, and the same is to be remitted by the seller to the Government of India at an appropriate intervals of time. Till sales GST payable is paid, the same is reflected as a current liability on the face of the seller's balance sheet. When sales GST is included in the sales, the relevant entry is, example, goods sold for rupees 50,000, which includes sales GST of rupees 5,000. Then the following entry is passed. Cash or bank account data rupees 50,000, to sales account rupees 45,000, to sales GST payable account rupees 5,000. Friends, sales GST payable is treated as current liability till it is remitted by the seller to the Government of India. When sales GST payable is paid, the following journal entry is passed. The entry is sales GST payable account data to bank account. Friends, already we have learned that all nominal accounts are to be closed and their balances are to be transferred either to the trading account or to the P&L account. In trading account, we show all direct expenses and direct incomes. In P&L account, we show all indirect expenses and indirect incomes. Meaning thereby, if the nature of expenditure is revenue, then it is shown in the trading and or P&L account. If it is revenue expenditure, it is debited to trading and or P&L account. If the nature of income is revenue, then it is credited to trading and or to P&L account. If the nature of the item is capital, then the same is reflected on the face of balance sheet. Friends, usually all capital expenses we show as assets and capital receipts we show as liabilities. It is very important point to make a note that students should well aware of the revenue and capital principle, which is already discussed. Here let us take one example, friends, how the normal accounts are closed. Example, wages paid to labor. Wages paid is a direct expense and it is to be debited to trading account. The entry is wages accounted are to cash or bank account. Already we have discussed that only normal accounts are to be closed. Since cash and our bank account is not a nominal account, it is a real account, also called as asset account, also called as property account. It is balanced. The balance of this account is shown on the asset side of the balance sheet. Whereas wage is a nominal account. The same account is closed and the balance of this account is transferred to debit side of the trading account. Similarly, all direct expenses are debited to trading account and all direct incomes are credited to trading account. Friends, already I told you the items which are usually debited to trading account are 2 opening stock, 2 wages, 2 purchases. Purchases will be reduced if any drawings are made by the proprietor, if any goods are distributed as free samples or for charity purpose, if any purchase returns are there. Then all direct expenses, example, freight on purchases, carriage on purchases, loading charges, unloading charges, all kinds of cesses, import duty, export duty, octroi, etc. are debited to trading account. The items which are usually credited to trading account are sales and closing stock. Here all the items which are debited, example, wages, purchases, freight. Then what is the closing and transferring entry? Then trading account debtor to opening stock, to purchases, to all direct expenses. Similarly, the items which are credited to trading accounts are also closed. The entry for that sales account debtor to trading account, closing stock account debtor to trading account. Then trading account is to be balanced. The balance of the trading account is to be transferred to profit and loss account. If debit total of the trading account is greater than credit total, it does amount to gross loss. If credit total of the trading account is greater than debit total of trading account, it does amount to gross profit. Friends, now let us discuss about profit and loss account. Profit and loss account is prepared to ascertain the net results of the business concern. That is net profit or net loss. The items which are usually shown in the P&L account. One simple thing we can keep in a note, friends. The revenue expenses which are not debited to the trading account are debited to P&L account. The income which is not credited to trading account, then it is credited to profit and loss account. Friends, it is very clear. If I know the preparation of trading account, it is very easy to prepare profit and loss account. I repeat, friends, the expenses which do not find place in the trading account are shown in the P&L account. The incomes which do not find place in the trading account are shown in the profit and loss account. All indirect expenses such as salaries, rents, rates, taxes, printing, stationery, postage, telegram, telephone expenses, general expenses, office expenses, bad debts, sales expenses, sales promotion expenses, advertisement expenses, any other indirect expenditure is debited to profit and loss account. Similarly, all indirect incomes. Example, rent received, interest received on fixed deposits, dividend received, commission received, discount received, profit on sale of asset, any other income is of revenue nature is to be credited to P&L account. Friends, one thing I want to make it clear that what is expense? Expense is nothing but expired cost or expired benefit. The benefit of that cost is expired, then it is to be debited to either to trading account or to P&L account. If it is of direct nature, it is to be debited to trading account. If it is of indirect nature, it is to be debited to P&L account. Here we do not differentiate between the operating expenses and non-operating expenses. Though it is operating expense or non-operating expense, all such expenses are debited to trading and our P&L account. And we don't have any such segregation even in case of revenue income. Though it is operating income or non-operating income, it is credited to trading and or profit and loss account. If the total of debit side of P&L account is greater than credit total of P&L account, then it does amount to net loss. If credit total of P&L account is greater than debit total of P&L account, then it does amount to net profit. If it is net profit, the same is transferred to capital account and it is added. If there is any net loss, it is deducted from the capital account. Friends, similar to that of trading account, the expenditure which is of indirect nature is also closed and transferred to P&L account. Example, salaries paid. The entry for salary paid is salary account at R2 cash or bank account. Salary is of nominal nature. Then salary account is closed at the end of the year. The balance of the salary account is transferred to P&L account since it is an indirect expenditure. Similarly, all such indirect expenses are closed and their balances are debited to P&L account. If the nature of item is revenue income, indirect income, then it is credited to P&L account. Then the closing entry for all expenses. Example, profit and loss account debtor to salaries account, to sales expenses account, to general expenses account, to bad debts account, to discount allowed account, etc. For income, rent received account debtor, discount received account debtor, commission received account debtor, dividend received account debtor to profit and loss account. Friends, now let us discuss about balance sheet. See friends, profit and loss account is prepared for a period of time. That is, if the period is a financial period, then it is prepared for the months of April to March. That is 1st April, say examples, 1st April 2019 to 31st March 2020. Whereas balance sheet is prepared as a specified date. Trading and P&L account reflect the financial performance of the business concern for a stated period of time. It reflects the transactions for the whole year. Whereas balance sheet reflects the very position of the business concern as a specified date, that is on the balance sheet date, also called as reporting date, that is 31st March, so and so. 31st March of the relevant year. Say example 31st March 2020. So in balance sheet, we have two divisions. That is again left hand side and right hand side. On the left hand side, we show the liabilities. On the right hand side, we show the assets. Left hand side, that is on the liability side, we show capital and it is duly adjusted with a net profit. If there is a net profit is to be added. If there is any net loss, it is to be deducted. If there is any interest on capital in case of partnership, it is to be added. Interest on drawings, if any, deducted. If any additional capital which is brought into the business, it is to be added. If any drawings are made with the proprietor, the same is to be deducted. Then we arrive at closing capital. Then we show long-term loans from commercial banks or any other financial intermediaries, financial institutions, and we show current liabilities. And asset side, we show fixed assets, current assets, investments, etc. Friends, here I want to re-emphasize once again, or just I'm asking the students to recollect what is meant by current asset, what is meant by fixed asset, what is meant by current liability, what is meant by long-term liability, which have already been discussed in the previous chapters. So what is fixed asset? When it is called as an asset, when it is bought, the intention is not to resell immediately. Otherwise, the intention is very clear on the part of the business enterprise to use this as asset in production of the goods or in providing of the various services. Whereas current assets, they are held for converting into cash. Example, debtors. Debtors is not a fixed asset, it is a current asset. Inventory is not a fixed asset, it is a current asset. Whereas land is a fixed asset, it is not a current asset. Of course, friends, what is fixed asset, what is current asset? When it is fixed asset, when it is current asset, depends upon the nature of operations of the business concern. If the intention is to sell immediately in the near future, say within 1 year, then it is termed as current asset. If the intention is not to sell immediately or in the near future, say within 1 year, it is termed as fixed asset. Similar logic we can apply even to the current liability as well as to the fixed liability. Friends, here we have certain terminology called as tangible asset, intangible asset. What is tangible asset? The asset that which we can see, that which we can feel, that which we can touch, and whose value can verily valued having applied some measurements. Whereas intangible asset, only I can feel, I can't touch. They don't have any physical existence. The value of the intangible asset is very difficult to ascertain. Example of such intangible assets are goodwill, patents, copyrights, trademark, license, computer software, technical know-how, licenses, etc. The examples of tangible assets are land, building, plant, machinery, furniture, fixtures, leasehold property, etc. Friends, investments are categorized into two types: long-term investments, short-term investments. Short-term investments are treated as current assets, whereas long-term investments are treated as long-term assets. While preparing the balance sheet, we need to follow certain rules and regulations. The arrangement of assets and liabilities in certain groups and in a particular order is called as grouping, and presentation of the balance sheet of business, this is also known as marshalling. Here we have two orders, friends. One is liquidity order, the another one is permanency order. In case of proprietary concerns as well as partnership concerns, any order can be followed. But as per the Company Act 2013 and any other relevant act applicable, permanency order is to be followed. What is liquidity order, friends? In liquidity order, first we write the highly liquid asset, that is cash in hand, and we closed with least liquid asset, that is goodwill. In case of permanence order, the reverse strategy is followed, that is least liquid asset is written first, that is goodwill. The highest liquid asset is written in the last, that is cash in hand. Friends, already we have discussed that in balance sheet we reflect mainly capital items. If the item nature is capital expenditure, it is shown on the asset side. If the item nature is a capital receipt, it is shown on the liability side. Friends, now let us discuss some important adjustments. These important adjustments are very useful in the preparation of final accounts. Number 1, closing stock. Friends, already we have discussed the entry for closing stock, that is closing stock account at R2 trading account, or even we have an alternative entry for closing stock, that is closing stock account at R2 purchases account. If closing stock is not given in the trial balance and if it is given as an adjustment, then such closing stock is to be credited to trading account and it is to be shown on the asset side of the balance sheet. Friends, each adjustment appears twice or thrice. Number 2, outstanding expenses. Friends, what is outstanding expenditure? The expenditure which was supposed to be paid but not paid is called as an outstanding expenditure, and it is treated as a current liability. Current liabilities are to be credited. Then the relevant entry for outstanding expenditure is the concerned expenditure account at R2 outstanding expenditure account. Friends, it is very simple to generate the journal entries having applied the modern concept. Why your expenditure account is to be debited? Since the expenditure payable is not paid, the future expenditure is going to increase, and when the expenditure increases, it is to be debited. And the expenditure which is payable not paid is treated as a current liability, and current liabilities are to be credited. That is, all liabilities are to be credited. Then the adjustment is, if it is given as an adjustment, example, outstanding wages, then it is to be added to the concerned wages head to the debit of trading account, and the same is shown as a liability on the face of the balance sheet. Next, third adjustment is prepaid expenses. Prepaid expenditure is treated as a current asset. We know that all current assets are to be debited. Similarly, prepaid expenditure account is to be debited. And your question arises, which account is to be credited? Friends, expenses show debit balance. The expenditure increases debit, the expenditure decreases credit. Since the expenditure which is to be paid in the next year, paid in the current year, the future expenditure is going to come down, then such expenditure is to be credited. Then the relevant entry for prepaid expenditure is prepaid expenditure account at R2 concerned expenditure account, and the adjustment is, it is to be deducted from the concerned expenditure and the same is to be shown on the asset side of the balance sheet. Example, rent paid in advance. Suppose per month rent rupees 10,000, per annum it will be 1,20,000. Whereas the enterprise paid rupees 1,30,000. It is very clear that they have paid rupees 10,000 in advance. Friends, we need to follow various concepts very strictly in drafting or in drawing in the preparation of financial statements. That is accrual concept, matching concept, going concern concept, periodicity concept, etc. Here I need to take accrual concept, periodicity concept, matching concept into consideration. The expenditure which is not of current year, which is of next year, it is to be deducted from the current year expenditure and the same is to be adjusted in the next year. And hence, the rent for the year is only rupees 1,20,000, whereas the rent paid actually is rupees 1,30,000. So 10,000 paid in advance is to be deducted to arrive at rupees 1,20,000, which is of current year rent. Since rent paid, that is rupees 1,30,000, which includes rupees 10,000 paid in advance, the cash has been flown out rupees 10,000, because of which on the asset side balance sheet is understated. So the balance sheet asset side is to be escalated, and the same escalation has been done, or same adjustment is done, or same rectification has been done by showing prepaid expenditure on the asset side of the balance sheet. Friends, I repeat, if any expenditure is prepaid, such expenditure is to be deducted from the concerned expenditure account, either to the trading account or to the P&L account, and the same is to be shown on the asset side of the balance sheet. Number 4, income receivable. What is income receivable? It is also called as accrued income. That is, income earned but not received. Here again, we follow the concept of matching accrual periodicity very strictly, friends. So example, I have to receive per month interest rupees 5,000. It amounts to rupees 60,000 per annum, whereas I received rupees only 50,000 for the year ended. How much I have to record here, friends? Interest, that is rupees 60,000. Though I receive rupees 50,000, though I do not receive rupees 10,000, which I may receive in the future, the same is to be added to the rent received rupees 50,000 to arrive at rupees 60,000. And again, such income receivable is shown on the asset side of the balance sheet. The entry is income receivable account debtor to concerned income account. Why I debited income receivable account, friends? Income receivable is treated as an asset, assets are to be debited. Then why I credited income receivable account? Why I credited the concerned income account? Since that concerned income is not received, that I may receive in the future, then future income is going to be increased. Income shows credit balance, increase credit, decrease debit.